Hello, everybody, and Happy New Year. We finally made it to 2025. Mike Sorrentino here along with Bepin, and boy, has this year started off with quite
Fireworks. It's just up
fireworks.
and
I'm
down.
almost afraid to say anything that relates to fire with what's going on the West
Oh,
Coast.
fair,
But
fair.
yeah.
Pull
Look, I mean,
ourselves in a Biden situation.
it has been a wild couple weeks. We have a new president as of Monday, or I guess let
Yes.
me rephrase it, returning president rather.
Yep.
And we've got a lot going on, and it's easy in times like these to get overwhelmed with where to start thinking about what's going to happen to the economy, what could potentially happen to the market as a result of the economy. And what we try to do here, what Beb and I try to do more times than not when we're looking at investment opportunities, is to take what we call a first principles approach. What
Yep.
that basically means is let's get down to the root driver of the economy, and from there, start doing our analysis and see if the initial root cause of what all of this stuff that we're currently experiencing as Americans will continue, and if so, at what rate. So that being said, let's go ahead and jump into the data and the equations and all that other fun stuff. Disclosures are boring. Let's get to fun
Yeah.
quotes from Ludwig von Mises. The real bosses in the capitalist system of market economy are the consumers. That's it. First principles,
Yep.
consumers. Consumers are everything, as you'll see in just a second. When I think about GDP, gross domestic product, which is a measure of economic activity, okay, in the US, there are four components to GDP that are most often cited. The first on the left-hand side of this chart is, as you can see, consumption. That is consumer spending, what we do on a day-to-day basis. If I go get a haircut today, if you go out to dinner, watch a movie, whatever it might be, when we are spending money, that consists of 68% of our total GDP. So call it two-thirds of economic activity in the United States. Two-thirds is
Yep.
literally just being Americans, going out and putting your credit card down and buying stuff. That is our economy right there. Go one bar over, 18% business investment. That is a very fancy way of saying business spending. Spending.
Hmm.
So you can almost stop there to a certain degree. 86% of the US economy is nothing more than consumers and businesses swiping their credit cards, taking loans out for houses, whatever you want to call it, it's spending. That
And
is the US economy.
I'd argue that consumption drives business spending. Like, why do businesses spend more money? Why would they
A
go and invest in a new
hundred
building,
percent.
a new storefront? It's all because they have high demand, which comes from consumption.
100%. Now, that quote you saw earlier, I thought was an interesting one. I have a modified analogy that I like to use when I talk about GDP and spending and all that other fun stuff. It's easy to look at things like the deficit. It's easy to look at things like government bloat, if that's a concern of yours, and all these other crazy things going on in the world. Ultimately, I like to think about the US economy as like a soccer field or a football field or some type of sporting event. Okay. The players are the US consumer and businesses. The players are the ones scoring the goals, making progress, moving down the field. The government, they're the referees. Okay. They can set the rules, but they're not the ones moving things forward. That is how the US economy works, which is why you see government spending being kind of a smaller number, and frankly, doesn't really move the needle anywhere close to what the US economy, I'm sorry, the US consumer and businesses can do for our country. So, again, first principles. If we say that consumers are driving the US economy and to a lesser extent businesses, which Bepin has mentioned is really a derivative of consumer spending or a byproduct rather, then we got to ask ourselves, can consumers continue to spend? It's that simple. So let's figure that out. Well, as we know, the stock market, we talk about this all the time, is what we call a discounting mechanism. It looks into the future and determines what could potentially happen, and it tries to take those future expectations and bake them into a stock price or an index price that makes sense. And right now, across the board, consensus numbers, meaning all those fancy investors up in Wall Street and all over New York City and San Francisco and all those big shops, they're all basically saying that their expectations are that consumer spending going forward, or consumption, however you want to call it, is rising, and it's going to be higher going forward. This is a big deal, okay? For a couple of reasons. One, again, if the majority of our economic activity is consumer spending, and the expectations of spending are going to go higher, that means that economic activity should theoretically net higher as well. And that is a very, very good thing for the US economy. Another thing that we want to watch, though, is that, again, as I mentioned, these are the expectations being baked into stock prices today. All right. So from an active management perspective, what Bepin and I are going to look at here is, over time, are these expectations going to be right? Now, generally speaking, most economic data is not right. Okay. The question is, how far off is it from the actual result? I will say, though, generally speaking, and Bepin, correct me if I'm wrong, but consumer spending expectations or consumption expectations tend to be a very tight distribution. So if it's off, it's not off by all that much.
I mean, they're just going off of payroll increases, and they assume that the U.S. consumer spends 90% of what comes in, so it's a pretty accurate measure.
I think that's a pretty low. 90% sounds really low.
I'm being generous, Mike. I'm saying that we have some fiscally responsible consumers out there.
So then you think about, it's interesting. We talked about GDP earlier, and while GDP is a perfectly fine number, there's a couple of problems with GDP. One, it gets revised 3 times over the course of 18 months. It's an imperfect number, but I think the biggest problem with GDP is that it is a lagging indicator. It's looking in the rearview mirror to see what has already happened. I just mentioned a couple minutes ago that the stock market doesn't work that way. Stock market looks forward, not backwards. So there is a difference between a lagging indicator like GDP and one that's what we refer to as a leading indicator, meaning the data that we see today is leading us in the direction in the future, okay? And I think one of the strongest leading indicators out there for consumer behavior is weekly retail sales, okay? Now you might be saying, we're long-term investors here. We look out over the course of, I'm going to make this up, 12, 18, 24 months. Why are we looking at weekly sales data? That seems like it's very, very granular. But weekly sales data on a week-by-week basis, you're right, or that is correct, rather. It doesn't really tell us all that much. But if you look at an extrapolated trend of all these weeks over time, then you start to see a picture get painted, okay? And we have seen very steadily growing retail sales for the last, call it 18 months or so, maybe even a little bit longer than that. So you got to ask yourselves, all right, and this is where the work comes into it. What would need to happen for weekly retail sales? This longer term trend of 18 months. What would need to happen for it to derail or change in some manner? And this is where the conversation for first principles expands. It says, okay, we got to start looking at other data to figure that out. But right now, I think, and Bepin, feel free to debate me here. I think it's going to be very difficult to find a realistic case where retail sales and spending is going to materially fall from here.
I don't think it'll be a case of ability. I can't see any reason why they wouldn't be able to keep spending. Now, things with willingness, which is the other side of consumption, which is you add, are you willing to spend, and do you have the ability to spend? And that basically gets you what you're going to consume. We could see something happen with the willingness, anytime there's uncertainty, there could be some push to getting, keep those pennies in the savings account for a rainy day that you think is coming. But in terms of ability, as you'll see in the charts coming up, we can't seem to find anything that would lead to suggest that retail sales should come down over the next year.
I would say this millennia, since 2000, the one time that I've seen a true actual change in consumption behavior, one time, after the financial crisis, and that lasted
consumer society and
18 months.
And to be honest with you, that is why we see such fantastic growth in the U.S. economy. It's because we consume. Everybody spends everything. But one of the big things that you've been seeing probably on the news or whether it's on social media has been this narrative that credit cards are likely the cause of all this spending. You know, the reason that everyone's able to continue to spend and spend more at all these stores is because they're just swiping away and not worrying about the bill and letting that rack up. This data that you're looking at here is showing the credit debt, total credit debt across the entire economy, as in like credit cards, but revolving consumer credit, divided by disposable income. So right now, the credit debt that we have is around 6 to 6.5% of our disposable income. That is a very healthy level. As you'll see in those gray highlighted areas over to the left in 01, obviously the dot-com bubble, and then 08 with the great financial recession, that ratio got up to almost 10%. And that's when you really start seeing trouble. But as you'll see post 08, there's been a huge deleveraging of the consumer. We, as irresponsible as we've been making the consumer seem to be since 08, they've been getting their affairs in order for the most part, bringing those leverage ratios, which this would be, because leverage is just how much do you have borrowed versus how much you have coming in. This leverage ratios come down, and it really bottomed out, as you'll see in 2020 and 2021, and that was due to stimulus payments. A lot of those stimulus checks went to American Express, Visa, and MasterCard, which is for the best. You know, that's a bad debt to have, which is credit cards, and that's usually the first sign of stress. When we start seeing this pile up, that's when we get worried about the market. That's when you can start worrying about some consumption actually coming down, is when your debt starts eating up so much of your disposable income. How can you spend more at the store? No one will let you lend or no one will let you borrow money from them. Which, speaking of letting you borrow money from them, credit access is expanding. And what does credit access mean? This is just a survey data showing, they ask households, is it easier or harder to obtain credit than it was 1 year before? And if you see that line going up, that's showing you that it's getting harder than it was before. If you see the line coming down, it was getting easier than it was before. As you'll see, since looks like summer of 2024, we've been coming down, as in credit access has been easier to get. People are willing to lend money. And one of the big reasons for this, in our opinion, would be that banks have just gotten comfortable with the environment. You know, when rates go from 0 to 5% on you overnight, almost overnight, took about a year, but when rates go from 0 to 5% on you, you're going to be a little bit tight around the belt. You're going to wait and see. You're not going to be letting out loans leave the door as frequently or without as much scrutiny. And now, as they've gotten a little bit more comfortable, they've seen the consumer's been able to be resilient even in the face of high inflation. They're much more willing to lend money than they were previously, which is great, because that is what drives the economy. As much as we like to say that like people just spend what they make, people borrow money for big purchases, and that borrowing allows the purchases to occur, which big purchases lead to a lot of income for the other side. And the money just goes round and round in our system. Speaking of not just borrowing, savings are also rising. Particularly, this is a chart showing, this is broken down by the income distribution, by you got the 0 to 20 on the left, all the way down to actually just the top 1 percentile on the far right. The one to the left of that, the 80th to the 99th percentile, that is basically you combine those two to make the last quintile. And what we're seeing is savings are going up. Now, I know it's a little difficult to see on that 60 to 80, but we've looked at the table data. It is rising. It's just hard to see on this shrunken down chart. The more visual one that you can take, that you can see, is the 80 to 99 percentile, which is the top 19, let's say, percent of the US income distribution. And they've seen some meaningful rise in savings. So this would all speak to the ability to keep spending. If you have savings, you are able to keep spending. And one of the reasons why we really focus on the top 40% is, if we go to this next chart here, they make up the majority of spending. Yeah, obviously there's some income inequalities in our society, but at the end of the day, we're here to just focus on the facts. And the facts are that the highest income quintile, which is the top 20%, and the next highest 20% make up over 60% of spending in the US. That's almost 2/3 of spending are made up by 40% of our society. And that 40% is seeing their savings rise, they're seeing their disposable income rise, their access to credit rise. And we still expect rates to come down throughout this year. So we would expect that even easier credit for them to get more money borrowed and spent. This all points to what Mike was saying. This is a first principle effect, but where does all the spending go to? It goes to these major S&P 500 companies and to the mom and pop shops all over our cities and towns. And that money that we're spending is their income, and their income goes directly back into the society. You know, these shareholders like S&P 500 companies take that income, pay out employees who go and spend the money. And so the more money that is spent, the more the economy grows. And from what we're seeing, like I was saying earlier, I can't find a thing that would lead me to believe that the ability to spend will be substantially diminished in 2025. And with that, we'd like to thank you for tuning in. As always, feel free to reach out with us with any questions you may have. Let's hope for another fantastic year in the market. We'll be watching and waiting and here to guide you through. Have a great rest of your day and enjoy your weekend. Thank you.